Apart from hikes of sin taxes, no other tax increases were announced in Finance Minister Enoch Godongwana's budget speech. Government's fiscal position has also improved since last year, mostly due to tax revenues exceeding expectations by a mammoth 181 billion rand. For more analysis, we are joined by Yolandi Esterhuizen, who is the tax practitioner at Sage Africa and Middle East. Yolandi, thank you so much for your time. Let's get into some of the hits and misses for you when it comes to this particular budget.
So to start with, I mean, there weren't many surprises, and I think, we all agreed that there shouldn't be really major tax increases. We knew that increasing VAT would be detrimental to the public, and seeing that our revenue collections were more than expected, like you've mentioned, it wouldn't have made sense to increase personal income taxes. But I mean, we know our fiscal remains under pressure, and the minister himself said that he doesn't believe raising taxes would boost government revenue. So it will only change the behavior of the public or the taxpayers. But then, yes, there were other things, a bit of a surprise, obviously, just the introduction of new taxes, the tax on vaping products and beer powder. And the only surprise was actually just that there wouldn't be an increase in the fuel levy and the road accident fund. But what he did mention, and I think was quite important for small businesses, obviously the corporate income tax rate. That was also not a surprise to anyone, but because it was mentioned in last year's budget speech, that it would be reduced to 27%. And I was actually, waiting in anticipation, because I thought at one point maybe it might not be implemented, seeing that nothing else was mentioned since last year's budget speech. So I'm quite relieved that that is also now being implemented for companies with a year of assessment ending on or after the 31st of March 2023. Something else that stood out to me was the employment tax incentive that will now be increased. So the amounts will be increased with 50%. Now, what I was hoping for, and during the State of the Nation, the president said that they will announce plans to make it easier for employers to actually participate in the employment tax incentive program. Now, a lot of employers actually don't participate in the employment tax incentive program, which is such a great program because we know our unemployment rate is sky high, and that will assist employers to getting funds available to be able to employ more people. And I was hoping that he would mention something about the simplification of the ETI administration. Interestingly enough, we recently, we've done our research, and we surveyed about 1,000 employers, small and medium size employers. And about only 52% said that they were actually currently participating in the employment tax incentive program. And the reason being, 40%, there was just a general lack of awareness of the program, which is quite a pity because it can help, especially the small and medium sized businesses. Then 25% of them said they had a fear of claiming the tax incorrectly. And 21% had concerns about the administrative burden being put onto them. So, a pity that these type of fears would put off employers where they can benefit so much. And we know if they utilize these programs that are put into place, not only can we improve unemployment rate, but it will also help in assisting the companies with their cash flows. So, yes, corporate income tax rate, obviously a relief to employers or companies in general, the employment tax incentive. If I can mention just something that I think, a big magnifying glass is put on is the disclosure of wealth taxes. We've been speculating for quite a few years that wealth tax would be introduced, and it hasn't been done. But with this budget speech, it was now mentioned that people, provisional taxpayers with assets of more than 50 million would have to be, or they would be required to declare their assets, of your specified assets and liabilities, market value, and I'm sure in their tax returns. And I'm sure that is something to pave a way for wealth tax.
I suppose then from a tax point of view, revenue point of view, you do mention as a first line item that we do owe a great deal of gratitude to the mining industry. But that can't last for too long, especially if you assume that the government might have permanent expenditure line items to fund infrastructure development or even the cases of social grants.
Absolutely. You know what? I think, yes, now we're paying social grants, and and there's a possibility of a basic income grant, and that itself, if it's paid beyond 2023, will put tremendous pressure on the fiscal even more. So we were lucky in terms of commodity prices and increased tax revenue collections, but it's definitely not sustainable. I mean, somewhere we're going to have to find that money. So it seemed like the effort is on broadening the tax base, and specifically in terms of non-compliance. We've seen that SARS have now appointed, I think, 490, if I'm not mistaken, additional people with different levels of skills, or skills levels. And, in terms of lifestyle audits and all of that, that will now be more focused on.
Right.
So, non-compliance, definitely a focus point, broadening the tax base. Absolutely.
Yeah. Yolandi, let's leave it there. Thank you so much for your time. Unfortunately, we have run out of time. That is Yolandi Esterhuizen, who is a tax practitioner at Sage Africa and Middle East, giving us her perspective on that tax.